Hi, people. Thank you for stopping by Building Wealth with Rajeev. Earlier, I had a chat with Emily Flippen of Motley Fool US. Our chat on cannabis was aired earlier. The link is below. We chatted on the investment scenario in China as well, especially after Evergrande and China government's crackdown on businesses. Emily is educated in China and she covers China as part of a job at Motley Fool. I hope you find the content useful. If you find the content useful, please follow the channel too. I think let's just spend another 15-20 minutes talking about or 15 minutes about China, Emily, where you lived for 4 years. And do you speak Chinese?
Very poorly.
Well,
Being
poorly.
conversational was a graduation requirement for my university, but let me put it this way: they were very nice in letting me pass.
Okay, so I've lived there for 5 years as well in Shanghai.
Oh, wonderful.
So yeah.
I was also in Shanghai.
Oh, you were also in Shanghai. Yeah, awesome. So what's going on with Chinese stocks after these the government things? I mean, what's your view? Are they going to come back? The stock, the businesses. I mean, are they investable now?
Let me say this. I've been an investor in China ever since I lived there, and I have not sold my Chinese holdings as a result of the regulatory changes that have happened in the country. But I will say this, they're happening very quickly, and I think they're happening at a level that we haven't seen historically. And I consider myself not a particularly risk-adverse person. I tend to just think, these things ebb and flow, and I still do believe that regulatory and policy does follow, especially in China, does follow an ebbing and a flowing, but I don't think that investors should necessarily plug their ears to it the way that I have over the past 5 or so years. Essentially, my perspective is nobody can tell you what's going to be next for China. Ultimately, I'm not even sure if the Chinese government quite understands what's going to be next for China. And if they do try to say, oh, this is going to happen, they're probably going to be wrong. But I do think you can make educated guesses about what you can expect for certain businesses and industries based off the stances and the policies that the government has in place. And I think the most effective way to do this is to look at China's 5-year plan. And they just released their most recent 5-year plan, I believe, in March. And it's challenging, I think, especially for non-Chinese speakers to kind of sift through this plan, because translations that you'll find online will lead you to have different opinions. And that's because it's purposely ambiguous. But I do think, to the best of your ability, getting a sense about what the Chinese government's 5-year plan is and how certain businesses will play into that or play against that can be really critical in determining where regulations will come out next. For instance, the regulations that we saw happen for education companies in China over the past year weren't completely unexpected, right? Xi Jinping and the Chinese Communist Party have been really open in the past, at least since 2019, saying stuff like the for-profit education centers are corrupt. They're breaking down, I guess, the education for our children. So it wasn't completely unexpected when that came through. So when I look at the most recent 5-year plan, I think about how do my investments play into that and how do they play against it? And if you look at the most recent 5-year plan, there were some key themes. Interestingly enough, I think one of the big themes was China really wants self-funded innovation, and they don't necessarily want that at the expense of keeping out foreign shareholder capital, but they do have a renewed focus on not surrendering control over national security. So I think one of the things that you can think about is how critical is this business for the Chinese people and for the Chinese government? If you actually have a really critical business, then maybe that ends up being a good thing, right? China wants that self-funded innovation. But again, how much intellectual property does this company own? Because if they own a lot, right, especially if it's related to data on Chinese citizens, then it may be increasingly hard for them to raise foreign capital outside of China, because that becomes proprietary, right? The Chinese government becomes concerned about access to information. It was the same controversies that we had here in the US over TikTok or Douyin and the data that they had on US-based users being sent back over to China. Well, the US isn't alone in those concerns. China has the same concerns, right? Didi, for instance, listing here in the United States, and the issues that went along there were largely because of the data that Didi had on Chinese citizens and their transportation usages. So those were concerns. I think there's 2 ways that you can read the most recent 5-year plan. In one sense, you can say, okay, well, any businesses that threaten these policies, I shouldn't be invested in. So businesses that have data on Chinese citizens, businesses that have a negative impact on the country moral ideals, and businesses that are run by leaders that could be threatening to the Chinese government. You'll find that's most of the big Chinese companies, right? All of those like Tencent, Alibaba, JD, Meituan, they all have.
Yeah, so I think
exposure.
that's the thing, Emily, because most of the investable businesses so far has been Alibaba, for example, has been a darling,
Yes.
right? And if you see, if you look at the Wall Street's estimates, it looks undervalued by like 50%. If you look at, I know more people doesn't believe in price targets, but if you look at other street, I mean, it looks 50% undervalued. So Alibaba, 10 cents, where do they go now? I mean, I know nobody knows, but what's the situation? People should take advantage, or people should shun, or
I think it's important if anybody's investing in these businesses to remember that whether or not a business is over or undervalued in China, it's not going to reflect that on US exchanges, in the sense that even if Alibaba is performing really, really well, there's always going to be a discount, at least for the foreseeable future, that is applied to the business that is China risk, right? The same way you would if there was any other binary risk in a business, you're not going to get the same valuation. Alibaba, if it operated in the United States, would have certainly a much higher valuation than it does in, being listed in the United States, but operating in China, because US-based investors are saying, I'm taking on additional risk by buying shares of this company. So it should trade at a lower price relative to some of its peers. And I largely agree with that. I do think they can still turn into great investments. I'm an investor in businesses like Meituan, like Pinduoduo, like Bilibili, which is a video streaming service in China. Like I like all these businesses. I come in with the expectation, though, that they're not going to be trading at Amazon level valuations simply because of the risk associated with them. That being said, they're critical for the development of China. So do I think the Chinese government is going to come in and stamp out these businesses entirely? No, not necessarily. That may change, but I don't see that happening the way it has with for-profit education.
yeah, I think, look, this is what I struggle with. For example, I had limited money, and I had to think about putting more money in Amazon or putting more money in Alibaba. I chose Amazon because of the same reason that a 10,000 buck in Amazon is probably better off if Amazon is not ridiculously valued. So in that sense, is there a need to take the risk?
No,
Is there at all a need?
I think it comes in line with my opinions about cannabis companies, for instance, which is you can do well by building yourself a diversified portfolio without necessarily investing in Chinese businesses. I will say this, though. I think it's important for people to have diversified exposure beyond their home country. I'm not saying that it has to be China, but I do think that if you're only looking at investing in companies that are, domiciled to where you're domiciled, and we see this happen all the time with Americans. Americans love to only buy American companies or buy funds that are only investing in American businesses. Make sure that you have some international exposure, because I'm calling out the United States. I'm most familiar with it. I'm sure it applies to other markets as well. But when you look at the growth trajectory for a macro level for a lot of countries, the United States had its peak, and it's still, Amazon, for instance, a great business, right? But there's going to be next best thing that's coming around in a country like India, like Brazil, potentially like China or Korea. So places that are up and coming beyond your home country, don't overlook them for potentially interesting investments.
Yeah, so let's say, I think thing on China again, what's the so all these video game, all these Tencent, they have data to it, right? And that will remain a bit. But there are semiconductor companies, there are possibly CPG companies. Are those the companies which investors should prefer over these data companies? Do you have a view on that?
I actually don't prefer to invest in again, just like CPG style companies. I host the Motley Fool's industry focused consumer goods podcast. That's a little hypocritical of me, but because I follow the industry and at this stage where I am in my life, I do prefer to invest more in growth. I think it does depend on what you're looking for out of your investments. I think those are probably safer investments. They're not completely abstaining from the risk of Chinese regulations, right? But less so than some of the higher tech businesses. But I still do believe we're talking about the largest consumer market in the world, especially with younger people coming into their own, for which they grew up in a very technologically enabled age. And I don't think that opportunity is going away just because they don't want people under the age of 18 to spend too much time online. In fact, if you break down the actual stats for a lot of these businesses, Tencent, Bilibili, Douyu, Huya, all of these businesses, very, very small percent, we're talking less than 1% of their revenue comes from people who are gaming under the age of 18. They're not monetizing that audience anyway, because they knew the Chinese government was not going to be happy if they were taking 15-year-olds' money. So I'm not sure it impacts them as heavily as what's being discounted in the market today, but it's always a risk.
Was this? So look, hearing you, Emily, I think you would invest more in Bilibili and Alibaba. Seems like to me you wouldn't stop. Sorry?
I will say I haven't going out of my way to buy more, and I think part of that is because I do think about my portfolio allocation. I don't want to overexpose myself as a person who runs a cannabis portfolio, who invests heavily in tech companies and Chinese companies. My portfolio already looks like a portfolio that is too heavily allocated in risky assets. So I haven't actually perceived this as a buying opportunity. I think I've expressed it more as a way for me as an investor to reflect upon my investment in Chinese businesses, set up my expectations for what the relationship between the government and Chinese companies will look like in the future, and then realign my expectations alongside those lines. And that coming to fruition, I say, there's not probably more obvious places to be sending your money right now, but I'm by no means interested in completely selling out of the country entirely.
And you're looking at semiconductors also, or is that
Taiwan Semiconductor is probably the only one that I'm familiar with. I think my concern with the semiconductor industry, and not that we're seeing this happen right now, right? We're in the middle of a shortage, but historically speaking, semiconductors tends to be cyclical, and we do see periods of where demand outstrips supply, as we're seeing right now for obvious reasons, but also where supply outstrips demand. And we're seeing a lot of these semiconductor manufacturers building out a lot of capacity that won't come online until 2022 or 2023. And then I expect at some point we'll probably see an oversupply of semiconductor chips. And right now, again, it's been such a critical industry, and there's so many different niche players within semiconductors, right? People who make certain aspects of the chip that are really not replaceable. They're interesting businesses. My fear is, these businesses are also trading at nosebleed multiples, right? Historic highs, that if there's any sort of slowdown in the industry, if we go back through a period where there's a trough in semiconductor demand, or in this case, oversupply of semiconductors, then we're probably going to see valuations for these businesses get pulled back. I think that's less of a concern if you're holding these companies for the long term and you have all the time, right, to sit there and play the cycle through.
And Evergrande, was that a surprise to you?
Yes and no. The regulations that the Chinese government put out around debt were not a surprise, right? These regulations have been coming for a long time. They've been in place. I think I wasn't quite aware to the extent that Evergrande was moving a lot of their financing off balance sheets. So it was a surprise to me to see this happen, in the sense that the Chinese government may reevaluate the way they look at off balance sheet financing, especially those set up through joint ventures. And I think the spillover effect from that is probably much greater on other businesses in a way that isn't being expected in the market right now. So I think it's probably an overstatement. We're seeing Evergrande referred to as the Lehman Brothers moment of China. I think that's probably an overstatement, but I'd certainly think there's going to be spillover effects, especially if the Chinese government re-looks at the way that it evaluates debt, right? If they start including things that are normally off balance sheet financing as part of that debt picture, it could impact a lot of businesses outside of just this one real estate developer.
And then you see, I think this is a good thing because everybody has this love of drawing parallels, comparisons. Evergrande, Lehman Brothers. You don't believe that? Is that? It doesn't look like that to you.
I'm not sure if I think it's going to happen at the same scale. I do think there's going to be some level of financial contagion that happens as a result of this, right? So if Evergrande ultimately ends up defaulting on its debt, declaring bankruptcy, the people who are its creditors are then probably going to be selling off other aspects of their other assets to kind of generate liquidity, which can then cause this spillover effect. And that gets really bad when there's wide scale panic and people start selling out of other assets because they're afraid of their values going down. And that contagion, that panic is, I think, part of the thing that could make this feel like a Lehman Brothers moment. I think it has a much bigger impact just on the millions of Chinese citizens who have their money held up with this business, right? Their deposits for this real estate that they're not going to get back. People who are real estate owners in the country who are likely to see their values contract on properties that they own. It's, in my opinion, sad and financially devastating to those people. It will probably impact every investor's portfolio in one way or another. But to the extent of the great financial crisis, I'm not quite sure I'm sold there.
Okay, and you think that more downfall will be coming? It may not be that extent of Lehman Brothers, but as you said, the companies are related. You guys looking into this, like what possibly? I'm not talking about the names or anything, but what sector possibly could be most hit? Could be banks or other real estate companies where the spillover effect would be.
Yes.
What to avoid? I mean,
I think it depends whether or not there's really big spillover. Depends on if they end up declaring bankruptcy and to the extent that they do default on some of these debts. Also, the extent that the Chinese government potentially comes in and takes action. We don't see implications of that right now, but if they actually perceived some sort of wide scale financial crisis, I would imagine there'd be action on the part of the government. Although, I could be wrong. So I think the biggest impact is obviously going to be for the banks first. So mostly Chinese banks providing financing for Evergrande. They're going to be the ones who are taking the biggest hit on this, again, which may cause them to sell up other assets. And I do think that the panic on the part of asset holders in China will spill over internationally. What impact that has on the average investor's portfolio, I think is probably TBD. I expect that there will certainly be fear around it, which will probably cause contraction in valuations across the world.